Peter, we're back.
Good morning, my friend. Monday morning.
New
week.
New week.
How about
another
it?
one.
We got some clarity, but the markets are certain. Getting the election out of the way was a good thing, I think, for traders, because Tuesday we had an incredible rally in the dollar. Euro just really put. It's so funny. I mean, those 2 weeks before, Glenn's running the numbers, and when we ran them, the beginning of October, I think Euro's range was 38 bips. And towards the end, the Euro range was down to, I want to say 26. And I go, Glenn, that's not right. And he goes, it's the math, dude. It's
right.
right.
He came over to me shaking, and he's like, how do I do a standard deviation?
Yeah.
Boss said it's not right. You were really, you're kind of scary guy.
But I didn't say that in a bad way, but it's just, it was right. And I don't remember a time where we had a 30-day 26 tick range. If you think about that, that is just...
It's sad.
Well, it's right. It's sad for traders. It's sad commercially, because within 26 points, what are you going to do? Buy the low, scalp it for 13 points, and then turn around? Nobody is that good.
I'll never forget when I started at the Board of Trade, and I was 22, and they put me on a sim for like a month or two, and they were like, you studied math at Michigan, like, you know what the heck's going on. We'll get you in like a real account. And I'm like actually shaking. And at that point in time, this is 2015, and interest rates, I believe at that time, were zero, short-term rates.
Yeah, still.
And I was trading... And I was trading treasuries. I was trading futures against futures, so like knobs, so 10s against 30s, 5s against 10s, 2s against 10s, 2s against 5s, all the different permutations. 2s against 30s, the tubs, that's your favorite, the tub spread.
And it's a wild one. Just because, guys, the more duration you add, the distance between the legs of the spreads, the more beta you have.
Less correlated, bigger moves between a 2-year treasury. And I mean, look at it the last couple of weeks. You know, the 2-year is moving in the same way that they think Fed is going to be hiking or cutting rates. And the 30-year is moving in a different direction where they think rates might be in the long term. Anyways, all these different spreads on my board, euro dollars, cash treasuries, all this different stuff. And everything was inside of like a 2 or 3 tick. All these spreads were a 2 or 3 tick range every single night. And the guys that had been there for, more than a decade, and the guys that were in charge who had been, like you, had 20, 30, 40 years of experience, they're like, that's the range. You just have to trade it. And I'm like sitting there and I'm like, I have to sell knobs at 2 and buy them back at 1. Like, what if they go to 4, which is normal in a lot of environments? And it's so hard. But we were in that range for, I think until I left. I was finally like, dude, this is not the thing for me. And I came over here to Tasty Trade. But it's crazy, one, how long you can be in a range like that. And we were in, a 25 to 35 tick range for Euro.
Longer than you think.
And 2, you're like paralyzed as to like, what am I supposed to do? Am I supposed to just again sell these 109.50s in Euro and try to buy 109.20s or 109.30s? It's really hard.
Right. Nobody's that good, and it's just too small. I mean, it was like when we first started working together, Eurodollar futures. How many times did we look at euros at 99.82?
Yeah.
Which basically was
exactly right. Yeah.
On the rounded edge of 0 for 90-day paper, which is where we were.
Yeah.
And those curve trades stayed flat far longer than we thought. Couple of fits, couple of starts. But my thinking is we've got this uncertainty out of the way. Now, whether or not this trade continues with equities on a tear, and now think about it. We are, bonds are right now at 117.15. We are starting to test the lower bounds. If we get to 116, that's relatively new areas. I think we've got there briefly. Euro below 107, stocks at all-time highs. Mm-hmm. There will be more elasticity in everything because whenever a market gets to a new level it's never traded at before, they're testing one side of the market's result, but you're getting to be, okay, where is fair value?
Yeah.
And so we're going to see more elastic. And Euros gave you a huge break on Tuesday night, huge rally Wednesday into Thursday. And then the selling Friday, especially in things like Aussie, was unrelenting. So we are well clear of that 107 level. We tried it twice. Big spike on Tuesday, I think 106.89 we got to 106.90 maybe, and we held all the way back up to 108.30. So 150 point range. We gave it back, and now we're plumbing new lows. So
I couldn't agree with you more that it feels like we just went through year end. Where it's like, oh, that liquidity kind of dries up at the end of the year, and everybody's kind of waiting for big institutions to have fresh books at the start of the year.
And that's all excuses. That whole end of the year.
For sure.
I mean, the whole, they're going to reload, this comes off. Markets move when markets move. And you know what? I've had some of my best months in December because things moved to new levels and got more elastic. And was it thinner? I don't know. There's always, trust me, if the market moves to new levels and there's interest, you'll do huge volume days.
Yeah.
It's not like it was 20 years ago where you'd go into the pit. Usually you have 100 guys there. There were 3. Then it would get a little bit more elastic. We took a little bit more liberty on where we were willing to buy and sell. But this is a different kind of global marketplace, especially, the $6 trillion a day going through spot FX cumulatively gives you a lot of liquidity. So
for sure. And yeah, my point more being that it feels like, we were coiling within this range. And let's take a look here at Eurodollar and take a look at the daily chart here. Going back the last several months, Pete, it looked like throughout the summer and even fall here, we were just stuck in this 107, 108, 109. And like I say, do I want to sell the 109.50s again? And then we got closer and closer to the election, saw some big moves, but still like 111, 112, nothing like we've seen in years prior. You see these huge moves up to 115, down to parity the last couple of years. And now it feels like we are just seeing huge swings here the last handful of weeks. But also, if I zoom in even further, you're not just seeing big moves. Look at these huge wicks. And we're not technical analysts by any means, but that just tells you it's a big friggin' moves, but big friggin' ranges around those moves as well.
And it is some, we go back to that last time I printed 112. That trade down from 112 to 109.50 was just pretty much straight down. And you had to, if you were trading the range, there was lots of places to get stuck. In other words, if you're trading a 200-point down move and you're looking for a 50-point bounce, you never got that unless you threw the dart perfectly. And nobody does. But here we're getting back and forth, which is what we want as traders. So, the one kibosh to this is somebody last night said to me, par's coming up next. And I'm like, oh my God, don't put a kibosh, don't put a jinx on this.
Yeah.
We're into levels we haven't seen, which is great. So that brings in a level of uncertainty, a little bit more dynamic ranging. It's interesting to see the dollar strength continuing to play through here, while interest rate, the curve itself, is flattening up. We saw it kind of steepen post-election. Bond yields were higher. The 2s to the 10s got out to 35 basis points. It's back to 5 basis points now. The 10s, 30s is 7 basis points.
Yeah.
So very flat curve, which is interesting.
But with that context, I would guess, and this is coming from someone who hasn't looked at any of it, and you know way better than me, and so you're going to have to either confirm or deny this. I would guess that the last time we were at this yield for 2 years, 2 years were trading on top of 10s and 30s.
Absolutely.
And so what you have now is, yes, a relatively flat curve compared to a couple of weeks ago, but 10-year 4.5% bid and 30-year 4.6% bid, whatever it is, those are right around the highs for those duration notes and bonds in the Treasury space. And so are we inverted again? No. Did we reach that parity in those extreme levels for U.S. dollar when we were inverted? Yes, but interest rates in the U.S. on the whole are higher than they've been, though the short term is just not ripping through the long term.
Absolutely. This is the case where when that yield curve normalizes, because 2-year yields fell so fast. This one is where 2-year yields are holding there and 10-year notes, 30-year notes are rising so quickly. Quickly being a relative term, but absolutely. So it's interesting to see that dynamic play through a little bit. Equities continue. Last night, Russell opened up and just exploded.
It's unbelievable.
25, 30 handles. Now, today's a holiday. The U.S. Treasury market the cash Treasury market is closed. Futures are open. Will it be a little bit lighter in the futures market? Yeah, I imagine the book will probably be a little bit.
What have 10 years done so far? I'm guessing they opened lower and
They opened relatively flat to a little bit higher and then sold off.
Okay.
So they're down. 10 years are down about 10 ticks, but they've done only 60,000.
Yeah.
So it's a light day. By this point, you'd be at 110,000.
But no sleep for the forex space, and
absolutely not. And
these are interest. I mean,
they tried an early rally right when the markets opened at 4 o'clock, and then futures came in at 5 o'clock. Little rally into euros, but there you see it there. It really didn't have much gas into it.
Well, and 106.50 here, where we're sitting for this euro, is the lows. We were just showing that daily chart. Is the lows for really the last 6, 7, 8 months, going back to April, May range in here, and they didn't get much lower. Went down and barely touched 106 even. And then 106 is the low going back to a full year ago, prior to the dollar giving up all of that going into year-end last year. Obviously, this year year-end is setting up to look a little bit different. That being said, Pete, you and I aren't, and it's funny, you say you were talking to somebody last night who's like, oh, parity's next or whatever. You and I don't necessarily care. Like we're not, man, if it gets to parity, I'm going to spend all my US dollars all over Europe.
It's not going straight there. And it's like they'll be back and forth. But what we've had is 5% move in this pair in a month. Now, on average, currencies move a skosh on either side of 3% a year going back 30 years. So we've had an annualized rate of 60% if you take that 5% over 30 days. That's a big outsized move.
Yeah.
Now, this is one where, again, it depends where your trading style is. If you're looking for a pot odds extreme, you're kind of there. If you're looking at structure and momentum, the longs are definitely being put to the challenge here. And we're at lows we haven't seen. And there is the ability for this market to bounce and sustain. And it's bouncing, which is nice. So you're getting nice bounces if you do want to play the extremes. But to hold is really challenged here. So, and you take a look at things like, if you want to jump over to Aussie, this is one that really...
I mean, this pair, Pete, has seen some of the best back and forth, I think, of any of these major pairs. And you're seeing here today actually holding on to unchanged, which is a rally against the dollar in today's market, because you can look here at the all pairs really quickly and you see pound is down 30, euro down 60, dollar putting in another 115 pips against the yen. And then you have Aussie here, which is actually able to eke out, unchanged, let's call it. But taking away a little bit of this 15-minute short-term view and taking a look at this daily view, or actually let me just go to the hourly to show this. I mean, Pete, these are huge two-sided moves in this Aussie. And you've seen two sides of euro to an extent, but like we say right now, sitting at 106.50 is really the lows. This Aussie right now trading a little bit under 66 cents. It's seen 68 and it's seen 65 in the last 48 hours of trading. And in a big way. I mean, huge moves. You see this. Obviously, this is the election move here in the big dollar rally. Everybody gets killed. And then there's a dollar sell-off, a little bit of comeback in a number of pairs. But this Aussie, by the end of it, by 24 hours after the election, Pete, Aussie was up against U.S. dollar, which you couldn't say of pretty much any major currency against USD, and then it sold off again going into the weekend, and now it's sitting in a little bit of no man's land. But this will be an interesting one because it's getting pushed on the equity piece and it's getting pulled on the US dollar piece.
You're absolutely right, and it's so funny because we've got PPI and CPI coming up this week, Tuesday and Wednesday, I believe.
Okay.
It's so funny when you don't have anything to talk about. Everybody talks about things like that. This isn't a high topic of conversation. Again, the calendar is great and it gives you the context around.
You got CPI, what is this, on Wednesday, and then on Thursday.
Is it Thursday? Yeah.
You got PPI and Powell, and then also some Japanese and Chinese data that night. So a heavy week for data, but what, you're saying that nobody...
It'll be interesting. It'll be parsed through, and will rates move off of it? Yeah. But it seems like there are bigger things driving the market. So that's why you always take the opportunity to have the algos run the binary event. In other words, they'll run it up, run it down, depending. If we get a 0.5 print, treasuries will trade lower. If we get a 0.1 print, they'll trade higher. Whether or not they stick or that's what's driving this, there's bigger things at hand here.
Well, it's interesting because we went through, you and I haven't talked since FOMC went through on Thursday. And that was one of the most boring FOMCs in recent memory. And I think a lot of it probably had to do with the fact that nobody cares. Like, they were set to cut rates. They cut rates. Everybody asked about, is Trump going to fire you? Or, like, what the heck's going to happen? He's like, no, whatever. And the market was like, this is nothing. This is all nothing. And so it'll be really interesting to see if, the CPI and don't throw the PPI off the table, because you and I both know that, like, the minute that you think one number is the number that's going to move everything, it's the other number. How many times we've set up for non-farm and been like, oh man, this is a big non-farm coming up, and it's the, JOLTS number 2 days before, and then non-farm is not so much. So we're going to watch everything, but it'll be what the numbers are and where the market moves after the event obviously will be interesting. But what'll almost be more interesting is, like, does it matter, or is the overall trend of this market, which is dollar strength, equity strength, crypto strength, metals actually seeing two sides more than anything, although
gold taking a beating today, silver down $1. Yeah, that's a big move.
So, are those trends more important than the state of inflation and employment at this point?
I think that movement is much more interesting than trying to gauge whether there was a bump up in inflation numbers for 1 month. I think, and you'll see the market, the only thing that's interesting for that is how does the market react, given that we're the high end of the range for the dollar, the low end of the range for these currency pairs, with a higher or lower inflation print. It may have a different reaction than if we were up at 112, we're down at 107, sub 107. Yeah. So that's the more interesting aspect of it. And again, these numbers are just opportunities to take advantage of movement. Don't try to guess what it is. Set your ranges, look for opportunity depending on what you want to do. If you're a momentum guy, you're either looking to, if there's a 50 pip rally on a soft employment number, you're probably looking to sell that in euro because the trend's going to continue lower. If you're a contra trending guy and the mark print is high, you're going to go and look to cover that, pick up something in the low 106s. But short of that, and then you're going to set your management area around that, and just, it's either going to get there, you're going to get something, or not, and you move on. Don't let the macro consume your ideas, because right now you're getting ranges, you're getting two-sided actions, which is what you want as a trader. So momentum or contrarian, you both are getting opportunities here.
Yeah.
And why the market is showing you it is widening out. There's more elasticity in everything now. Yeah. So because we are getting, gold is at a level we haven't seen. This is finally, remember, we're at 2,800. We're trading 26.65. This is the biggest shakeout we've seen since we broke through $2,000.
Yeah.
So longer term longs getting challenged a little bit. Start of the week. So it'll be interesting to see how that comes through.
Volatility is up across the board. And so, you're looking at, for example, this CPI number, which is actually forecasted to be 0.2% higher than it was previously. And so, of course, you would want to say, all right, well, the expectation is 2.6%, Pete, and we have a euro-dollar market here that's gotten absolutely annihilated. U.S. dollar is trading on its highs for the last several months. And so you want to say there's asymmetry in where this market can go around a number like this CPI, which 6 months ago was the most important number on the board. And so that would lead you to say something like, okay, well, this means that if we get, a 2.7 or 2.8%, then maybe we see another 50 pips or so lower in euro dollar. But if you see, a 2.4 or 2.3, something closer to 2, maybe dollar gives back a lot of these gains from the last week or so. But honestly, I don't feel that, and I can't say that it does. It feels like if we do get a 2.7 or 2.8, they might really find a reason to kill this euro and sterling and try to rally this dollar up again. And yeah, if the number does come in lower, then maybe you do undo a lot of the Trump rally in U.S. dollar, whatever you want to call what's been going on the last week. But yeah, all I can say, having no clue what any of these numbers are, what the reaction is going to be, is volatility's up across the board.
So we keep that in mind, that we set our scalping ranges appropriately. Lots of stuff to trade here. Kiwi, let's take a look at Kiwi really quickly before and then
same as that Aussie, just huge two-sided ranges and hanging right here, just shy of 60 cents, which if you go back historically, this 60 to 59 area has really been the lows in here. And so, man, we're not a week.
60-cent Kiwi is cheap Kiwi historically. So
I could take a look.
Kind of keep that in mind.
We've seen 66, 68, 70, and I'm sure if I go back to all the data that we have here from IG, you've got 80 to 85 cents. Jeez.
Yeah, you've got to go back to what, 2000. I remember trading 40-cent Kiwi. Yeah.
Holy smokes. If we get down there, there's probably going to be problems in the global economy.
Yeah.
Because the last time we saw sub 55 or 50, this is 08.
Let's jump really quickly. We got 1 minute to go.
Sure.
Let's take a look at Mexican peso, because that was one that actually, the election trade, so to speak.
Well, this was a really interesting one here. I have the monthly, so let me go back to the hourly. This was a super interesting one because peso, I know that dollar is rallying its head off right now against peso. But this was great two-sided trade, not what you would have expected, Pete. At certain points last week, especially going into the end of last week, dollar had actually lost ground peso. So classic.
Buy the rumor, sell the fact. And so everybody above 20 pesos to the dollar, we got a spike up there. They tested it as far as they could. And some sellers came in, and we traded below 20 really pretty quickly. Now we're seeing the trend reestablish itself a little bit. So, but what we're seeing is, and you're down to what increment are you at?
This hour.
An hour, which is a good slice to take a look at.
I go to the daily, and you can see that you're seeing this volatility right there at those extremes for peso.
So this reconfirms the fact of what you were saying. This is a dollar. Isn't a peso move or just a euro move. Is euro getting hit harder than things like Aussie and Canada at the moment? Yeah, but they're all is driven by the dollar. Now, sometimes we get currency-specific events that drive just that pair. I think this is that dollar trade continuing to play through. So it'll be an interesting week because we're starting out the week. Anybody who's short dollars right now is getting challenged in their position.
Yeah.
So it'll be interesting to see if they continue to build on this or we get a little bit of relief as we play through this. But with equities coming out of the gates stronger, bonds lower, I would imagine we probably see the dollar at least go through the first part of today in bid form. Whether or not they take something off the table, we'll see. But the ability to stage a rally has been kind of tough to do. So we'll watch euro. Everything's at really critical levels here. So it's good to see the elasticity come back in, the ability to trade both sides come back in. Just widen out your ranges a little bit, give yourself a little bit more opportunity because the market is providing you that.
Yeah.
So good stuff.
Man. Yeah.
Great week. I'm excited about this. This will be fun. We got uncertainty out of the way, which again lets us trade market movement, which is really important. We'll be back with you tomorrow at 6:30.